Welcome to Divine Traders. Let's analyze the first trade of the day, where the real move actually started. Now, we didn't trade randomly here. Price action was clearly respecting a key support level, showing that buyers were active at that zone. And along with that, we noticed aggressive position building from put writers, which tells us that smart money is confident about holding this level. So this wasn't just a normal setup. It was a confluence of price action and strong option data coming together. So now we've taken the trade, and from here, price psychology becomes important. The market often retests strong levels, not to break them immediately, but to confirm strength. And that's exactly what we saw. Price came back, retested the support, and continued respecting that zone. This kind of behavior tells us one thing: the level is holding and weak hands are getting filtered out. And when that happens, it usually indicates that a bigger move is building next. Now, once the retest was completed, we saw exactly what we were waiting for. Price came back to the support, respected it cleanly, and that confirmed that buyers were still in control and the level was holding strong. At the same time, the earlier buildup of strong positions, especially from the put writer's side, started playing out. And then the market reacted. Price moved sharply in a single direction, aligning perfectly with that positioning. There was no hesitation, no choppiness, just a clean momentum move. And within just one candle, it delivered around 37 points, showing clear intent and strong participation from big players. Now we can clearly see the smart money push playing out. The move extended to around 42 points in total. At this stage, we don't get greedy, we start managing the position. We booked partial profits to secure gains, and for the remaining quantity, we simply trailed our stop loss. This way, we lock in profits while still staying in the trade in case the momentum continues. Now we can see that price is still respecting the level, but our trailing stop loss eventually got hit, and that's completely fine. We already secured the move, and trailing helped us maximize the profit. After that, we notice signs of smart money entering again, but instead of rushing in, we stay patient, because every move needs confirmation. So here, we wait for a proper setup and look for the second trade from our key support zone. Price is coming back to our key support zone again, not randomly, but revisiting a strong level where buyers were active earlier. So we stay prepared and plan our second trade here, but only with proper confirmation. Now here, we take our second trade, as we can clearly see a liquidity sweep from the upside. The market cleared weak hands above, and at the same time, put writers were still aggressively adding positions, showing continued strength at this level. With both liquidity and positioning aligned, this gave us the confirmation to enter the trade. And now the trade is active, already delivering around 23 points, showing that the momentum is building as expected. And now we can clearly see that the same smart money which was active earlier is stepping in again, confirming the continuation of the move. This kind of repeated participation tells us that the trend still has strength. At this point, the trade has extended to around 53 points in profit. So here, we don't exit everything at once. We book partial quantity to secure gains and let the remaining position run with a trailing stop loss. This way, we lock in profits while still giving the trade room to continue. So now from this zone, we can clearly see there is resistance above and price is again coming back to retest our support level. At this point, it's very important to understand, is the market really holding support, or is it just creating a trap? So we don't rely on one factor, we combine price action with structure. Here, we draw a trend line and observe how price is reacting, whether it's breaking down or respecting the zone. And as we can see, price is respecting both the support and the trend line, showing strong buying interest. This confirms that it's not a trap, the level is still valid. And when support holds multiple times with confirmation like this, it increases the probability of price moving further upside. So here, we are willing to take the risk, but it's not random risk, it's calculated. Because the market at this point creates fear and FOMO, some traders are scared after the move, while others are chasing late entries. But we stay neutral because we already booked profits earlier. That's called proper risk management. Now again, we observe something important. The same zone where smart money pushed the market twice before, price is coming back to that area. And along with that, we can see put writers again aggressively adding positions, showing confidence at this level. This tells us that smart money is likely preparing for another move. And as expected, they step in again, and price starts moving strongly in an uptrend from that zone. And now we can see once again pressure from the put writers is pushing the market higher, creating a new high. This confirms that the strength is still intact. So here, instead of getting greedy, we follow proper execution. We book most of our quantity to secure maximum profit. And for the remaining position, we simply trail it to capture any further upside. Now this is where the real game begins. After such a strong move, the market doesn't just keep going in one direction. It needs fuel for the next move, and that fuel is liquidity. So what the market does here is shift into a sideways phase. But this is not random. This is a very calculated process. In this range, you'll notice something interesting. Breakouts above resistance fail. Breakdowns below support fail.
Why?
Because the market is deliberately trapping both buyers and sellers. Late buyers get trapped on fake breakouts. Early sellers get trapped on fake breakdowns. And in between, stop losses keep getting hit. This is how liquidity is created. Orders are filled, positions are built, and weak hands are removed. Most traders get confused in this phase. They think the trend is finished. But in reality, this is just preparation. Smart money is quietly building positions here. And once enough liquidity is collected, the market doesn't move slowly. It expands aggressively in one direction. Now we can see strong candles forming inside a sideways zone, and this is where most traders get misled. Because when the market starts printing strong candles in a range, people assume a breakout is coming immediately. But in reality, this is often the phase where liquidity is being engineered. The market doesn't move just on direction. It moves on orders. And for big players to execute large positions, they need liquidity on both sides. So what happens here? The price keeps rotating within this zone, taking out recent highs and lows again and again. This process clears stop losses, traps breakout traders, and forces emotional entries. Psychologically, traders start feeling pressure, fear of missing out on breakouts, and fear of being wrong in chop. But behind the scenes, this zone between the recent price and the previous smart money entry becomes a liquidity pocket. The market is simply filling orders, balancing positions, and removing weak hands. It's not about never losing. It's about controlling risk and entering where probability is highest. And once that liquidity is fully absorbed, that's when the market stops playing games and delivers the real move. Now, as we discuss the liquidity pocket between price and the smart money zone, we can see price coming back again, but this time with a clear liquidity sweep. Instead of a clean downtrend or breakdown, the market first takes liquidity and then reacts from the same smart money zone. This tells us that the move is not weakness, it's a setup. So here, we plan our second trade because price has returned to the zone with liquidity already taken. With no strong selling pressure and no major order cuts, this gives us confirmation that the level is still valid. And that's where we confidently execute our second trade. And now once again, we can see another liquidity sweep happening. Price takes liquidity first, and right after that, we see smart money stepping in again. This is already the fourth time we're seeing strong participation from big players at these levels. And repeated activity like this tells us one thing: the zone is still active and being defended. So instead of exiting early, we stay in the trade and continue trailing our position because momentum is still being supported. And now, as the move extends further, we can see we've captured a strong number of points again. At this stage, we follow discipline, we book most of our quantity to secure profits, and keep a small portion running with a trail, allowing the market to give us any additional upside. Now our trailing stop loss got hit, and that's completely fine. It's part of disciplined execution. From here, we can see price again approaching the big player zone, so we start planning our fourth trade around this level. But at the same time, it's important to note, our second trade is still active and running. So we're not overtrading or forcing entries, we're simply managing multiple opportunities based on structure and confirmation. This is how you stay aligned with the market, not by chasing but by reacting to key zones. Now we planned our fourth trade, and initially it started working in our favor, giving around 10 points. But then we noticed something important: aggressive call, writing coming in with heavy quantity. Now this is a key signal because strong call writers often create resistance and can slow down or reverse the move. So instead of holding blindly or getting greedy, we stayed objective and reacted to what the market was telling us. At that point, we made a disciplined decision. We exited all our positions completely. Because in trading, it's not about catching every single point, it's about protecting what you've already earned. And if we look at the overall performance, combining all 4 trades, we captured more than 150 points for the day. This is what real trading is: not prediction, but execution; not emotion, but discipline; and not greed, but consistency. Hope you liked this analysis video, and more importantly, I hope you learned something valuable from it. Keep learning, keep improving, and stay disciplined in the market. I'll see you in the next one. Goodbye.